Silver just had a rough day, and it wasn't a small move. The price didn't simply dip, it dropped fast, falling about 5% in a single trading session. For a market like silver, that kind of move grabs attention immediately. It's not the type of change you usually see on a calm day. Something clearly shifted. And here's the part that surprised a lot of investors. This move had nothing to do with war headlines, nothing to do with oil shocks, and nothing to do with supply problems. The usual stories people reach for didn't drive this. Instead, the pressure came from something far more powerful in today's market: expectations around interest rates in the United States. When interest rate fears rise, markets tend to react quickly. Investors start adjusting positions often before anything actually happens, and that's exactly what played out here. Silver wasn't the only metal under pressure. Gold also fell. It dropped by nearly 2%, losing over $80 in value and sliding to around $4,110 per ounce. That's a noticeable move on its own, but compared to silver, it looked almost mild. Silver told a much sharper story. It fell around $3.50 and traded down near $61 per ounce during the session, even briefly testing the low $61 range. That's important because the market started to get close to the $60 level, a zone many traders watch closely. When prices get near a big psychological number like that, tension builds fast. Platinum and palladium also moved lower. This wasn't just a silver story or even a gold story, it was a broad sell-off across precious metals. So what's really going on here? To understand it, you have to look beyond metals and focus on what the market is now pricing in. The possibility that the Federal Reserve could stay aggressive or even move toward higher interest rates. That expectation changes everything. When interest rates rise, money starts behaving differently. Investors can earn returns from safer, interest-paying assets like bonds or savings instruments. In that kind of environment, assets like silver and gold lose part of their appeal because they don't generate income. They simply sit there as stores of value. That shift alone is enough to push large investors to rethink their positions. And that's what makes today's move so important. It wasn't random panic. It looked more like positioning. Big players adjusting ahead of possible policy changes. But the story didn't start in metals. Early weakness actually showed up in other parts of the market first, especially in technology stocks. A wave of selling hit high-growth sectors as investors reacted to the same concern: higher interest rates in the future. When tech stocks fall under rate pressure, that fear often spreads into other markets quickly, and it did. That pressure then flowed straight into precious metals, accelerating the decline. At the same time, the usual market relationships also started breaking down. For example, oil didn't rise like some traders might expect during inflation concerns. Instead, oil also fell, dropping to around $73 per barrel. Normally, rising oil and rising inflation fears can support metals like gold and silver, but today, that connection didn't hold. That breakdown is important. It shows the market is not behaving in its usual patterns right now. Old relationships between assets are becoming less reliable, at least in the short term. All of this is happening while traders are closely watching the Federal Reserve. Recent Fed discussions had a more firm tone than many expected. In simple terms, officials sounded more open to keeping policy tight or even raising rates if needed. That kind of language is enough to shift expectations across global markets. Because once investors believe the Fed might stay aggressive, they start moving money out of assets that don't pay yield, and silver is one of the first to feel that pressure. So what we're seeing today is not just a price drop, it's the market reacting in advance to what it thinks the Fed might do next. And that's where things get more serious. Because if expectations keep shifting in this direction, the next few months could bring even more volatility. Not just for silver, but across the entire financial system. For now, the key takeaway is simple. Silver's drop wasn't driven by one event. It was driven by a change in mindset across the market. In the next phase, we'll break down exactly how Fed expectations, bank forecasts, and rate probability shifts are driving this pressure, and why institutions are reacting so quickly behind the scenes. To really understand why silver dropped so sharply, you have to look at what's happening behind the scenes in global finance, not just what shows up on a price chart. Right now, the biggest force moving markets isn't war, oil, or supply issues. It's interest rates. When the Federal Reserve signals that rates might stay high or go even higher, it changes how every major investor thinks. Banks, hedge funds, and large institutions don't react emotionally. They adjust models, forecasts, and portfolios based on expected returns. And that's where the pressure on silver begins. Silver doesn't pay interest, it doesn't generate dividends, it doesn't produce cash flow. So when interest rates rise, silver immediately looks less attractive compared to assets that do generate income. That's a simple idea, but it has huge consequences. because large investors constantly make a comparison. Where can my money earn the best return with the least risk? When rates are low, silver can shine. When rates rise, silver struggles. And right now, the market is increasingly pricing in the idea that the Federal Reserve may not be done tightening. This shift didn't come out of nowhere. It started after a recent Fed meeting where the tone changed noticeably. Instead of sounding relaxed about inflation, policymakers appeared more cautious and more willing to keep pressure on the economy if needed. That kind of tone change matters more than most people realize. Markets don't wait for action. They react to expectations. So even before any rate hike actually happens, money starts moving. And that's exactly what we saw. Large funds began reducing exposure to non-yielding assets. That includes gold and silver, not because they suddenly lost belief in metals, but because the cost of holding them increases when interest rates rise elsewhere. This is what people often miss. Nothing has to break in silver itself for the price to fall. The pressure comes from outside, and it's not just metals reacting alone. The first warning signs actually appeared in the tech sector. High-growth tech stocks were hit by a wave of selling as investors adjusted to the same concern, higher borrowing costs in the future. Tech companies depend heavily on cheap money. When rates rise, valuations often fall. Once that selling starts in tech, it rarely stays contained there. It spreads, and that spillover effect moved directly into precious metals. At the same time, oil added another twist to the story. Normally, oil and inflation fears can support gold and silver, but this time, oil also declined, falling to around the low 70s per barrel. That broke the usual pattern. So instead of seeing a risk hedge rotation into metals, the market saw a broad de-risking across multiple asset classes at once. That's a key detail. This wasn't money flowing into safety. It was money pulling back from risk everywhere. Another major factor is how quickly expectations around future Fed policy are changing. Markets now assign a rising probability that rate hikes could continue through upcoming meetings. Traders are constantly updating these probabilities based on new economic data and Fed commentary. As those probabilities increase, pressure builds on assets like silver in advance, not after the fact. This creates a kind of future shock effect, where prices move before the actual decision is made. That's why silver can fall hard even when nothing has officially changed yet. Because in modern markets, perception moves faster than policy. Banks are also adjusting their outlooks in real time. When major institutions revise forecasts for interest rates or inflation, they indirectly change their expectations for metals as well. If borrowing costs stay high longer than expected, the opportunity cost of holding silver increases. That leads to repositioning, and repositioning leads to selling pressure. It's not dramatic in execution. There's no single moment where everyone decides to sell. It happens quietly, step by step, across hundreds of institutions at the same time. And when that alignment happens, price moves fast. That's what created today's 5% drop. Not panic, not headlines, but coordinated adjustment to a changing interest rate environment. Now the key question becomes, is this just a short-term reaction or the beginning of a larger trend? Now we get into what major banks and market signals are really saying beneath all the daily price movement, because this is where the bigger picture starts to show up. After the Federal Reserve's recent shift in tone, large financial institutions didn't sit still. They updated forecasts, adjusted expectations, and quietly repositioned their outlook for both interest rates and precious metals. And those revisions matter more than most headlines. Some major banks have started pulling back from overly optimistic price targets for gold. Earlier projections that looked very bold are now being questioned. Not because gold has lost value as a long-term asset, but because higher interest rates change the entire valuation environment. When rates rise, the pressure increases across all non-yielding assets. That includes gold, and by extension silver, which tends to move even more sharply in the same direction. One important detail here is how banks now condition their forecasts. Instead of saying, gold will reach X price, they're increasingly saying, gold could reach X if the Fed stays on hold. That small phrase changes everything. It means the forecast is no longer based on metals alone. It is now dependent on monetary policy staying stable. If policy tightens, those targets quickly lose strength, and that uncertainty is exactly what the market is reacting to. Another major institution recently adjusted its outlook as well, suggesting that if rate hikes continue, gold could fall significantly lower than previously expected. These aren't casual predictions, they are scenario models based on interest rate paths. And when those scenarios shift, money moves. Silver feels that impact even more than gold because it's more volatile. It doesn't just follow gold, it exaggerates gold's direction. When gold falls, silver usually falls harder. When gold rises, silver tends to rise faster. That leverage effect is great during bullish cycles, but painful during corrections. Right now, that leverage is working against silver. Another important signal is the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Recently, it has stretched to around the high 60-to-1 range. That is historically wide. When this ratio expands like this, it usually means one of two things. Either gold is expensive relative to silver, or silver is being pushed down more aggressively than fundamentals justify. In many past cycles, when the ratio reached similar levels, silver later outperformed gold significantly once the market stabilized. But timing is always the difficult part, because ratios can stay stretched for long periods before correcting. So while the signal may suggest silver is undervalued, it does not guarantee an immediate recovery. In fact, short-term pressure can continue even while long-term value builds. This is where many investors get caught, confusing cheap with ready to rise. They are not the same thing. Cheap assets can stay cheap longer than expected if macro conditions keep working against them. And right now, macro conditions are still driven by one dominant force: interest rate expectations. The Fed's forward guidance, recent meeting tone, and ongoing economic data all point to a market that is still unsure how far tightening will go. That uncertainty is exactly what creates volatility, because every new data point, employment numbers, inflation readings, Fed speeches, can shift expectations again. And each shift forces another round of adjustments in portfolios. That constant repositioning is what creates the kind of sharp moves we saw in silver. Fast drops, strong intraday swings, and sudden shifts in sentiment. Another layer to consider is oil. Normally, oil plays a supporting role in the inflation narrative. Rising oil often supports inflation concerns, which can support metals. But recently, oil has not been cooperating with that pattern. It has moved lower at the same time as metals. That break in correlation is important. It tells us the market is not behaving in a simple inflation equals metals up way right now. Instead, it's being driven more by financial conditions, especially borrowing costs, than by commodity inflation alone. So even traditional relationships between assets are breaking down temporarily. And when correlations break, models struggle. That's when volatility increases. This brings us to a critical question many investors are now asking. Is silver entering a long-term correction phase, or is this just a short-term reset before another move higher? The answer depends almost entirely on what the Fed does next. If rate hikes continue or stay elevated longer than expected, pressure on silver can persist. If the Fed signals a pause or shift toward easing, silver could recover quickly, potentially sharply. Markets are currently pricing both possibilities, which is why we're seeing these wide swings. There is no clear direction yet, only competing expectations. And that uncertainty is exactly what makes this moment so important. Now we come to the part that really drives short-term price action. What the market is expecting the Federal Reserve to do next, and how quickly those expectations are shifting. Right now, traders aren't just reacting to what the Fed has already done. They are constantly pricing in what they think the Fed will do at each upcoming meeting, and those probabilities are changing almost every week. For the next Fed meeting in July, the market is still uncertain. There's a meaningful chance of no change in rates, but there is also a growing expectation that a small rate hike could happen. That split in opinion creates tension in the market, because uncertainty itself creates volatility. When investors are not aligned on what comes next, prices tend to swing more aggressively as new information hits. Looking further ahead to September, the picture becomes even more interesting. The probability of a rate hike rises noticeably there. More market participants are starting to believe that if the Fed hasn't acted earlier, it could move by that meeting instead. By October and December, expectations become even more tilted toward tighter policy. In simple terms, the market is gradually shifting toward the idea that higher rates may stick around longer than previously thought, and that is the core pressure point for silver. Because silver doesn't just react to rate hikes, it reacts to the expectation of them. This is why prices often move before any official decision is made. We saw that clearly in this recent drop. Silver didn't wait for action. It reacted to probability changes. Another important level traders are watching closely is the $60 zone. Silver dipped near that level during the recent sell-off, and that matters because big round numbers often act as psychological support in the market. When prices approach these zones, traders become more cautious. Some step in to buy, expecting support. Others sell in anticipation of a breakdown. That tension creates sharp intraday movement. So far, silver has managed to hold above that area, but it is being tested, and repeated testing of a support level is important. The more a level is tested, the more pressure builds around it. Eventually, either buyers defend it strongly or it breaks and triggers another wave of selling. That is why the next moves around this zone are critical. On a broader level, this entire situation reflects something bigger than silver alone. It reflects how sensitive global markets have become to interest rate expectations. Every Fed comment, every inflation report, every employment update feeds directly into pricing across assets, from tech stocks to commodities to currencies. And in this environment, nothing moves in isolation. Silver is especially sensitive because it sits in two worlds at once. It is both an industrial metal and a financial asset. That dual identity means it reacts to economic growth signals and monetary policy shifts at the same time. When growth expectations weaken and rates rise, silver gets hit from both sides. But when conditions eventually shift the other way, silver can respond just as strongly in the opposite direction. That's why long-term investors continue to watch it closely, even during periods like this. Now, stepping back, the key question is simple. Is this drop a warning sign or a temporary phase inside a larger cycle? The answer depends on time frame. In the short term, the trend is clearly being driven by interest rate expectations. That keeps pressure on silver and increases volatility. But in the longer term, the underlying demand story hasn't disappeared. Industrial use cases like solar energy, electronics, and electric vehicles are still growing. Those factors don't vanish because of one Fed meeting. So what we have right now is a conflict between two forces: monetary pressure pulling prices down, industrial demand supporting long-term value. And that conflict is what creates uncertainty. In moments like this, markets often move sharply in both directions before settling into a clearer trend. That's why the coming months matter so much. If rate hike expectations continue to rise, silver may face more downside pressure or extended sideways movement. But if the Fed signals stability or easing later in the cycle, silver could recover quickly as investors rotate back into non-yielding assets. There is no guaranteed path, but there is a clear structure shaping the movement. And within that structure, discipline matters more than reaction, because the biggest mistakes in markets usually come from confusing short-term volatility with long-term direction. Silver is not just reacting to headlines, it is reacting to a shifting global financial environment where interest rates sit at the center of everything. And until that center stabilizes, volatility is likely to remain the dominant theme. What matters now is not predicting every move, but understanding why those moves are happening. That's the real edge in a market like this. And that brings the full picture together. A 5% drop that looks sudden on the surface, but underneath is driven by a deep, ongoing shift in monetary expectations, institutional positioning, and changing market relationships.